Hello, everyone. Welcome back to Don't Rest Until You Invest. My name is Eric Spaulding. And again, if you're here, I know that you're a go-getter, so let's get into what we're going to be talking about today. Today, we're going to be doing a part 2 to the video that I made last time, Investing for Beginners. But this one is going to have a little bit of a twist on it. And that twist is that we're going to talk about the different types of investments. And for the main things that I'm going to address in this video is I'm going to address the type of payments that you receive from these investments, the level of risk that each one correlates with, the barrier to entry, and also the potential for gain. The reason why I'm hitting on all these is because I think for beginners starting out in investing, it's good to know what the things like barrier to entry is going to be. Because let's be real, not all of us have the same income or the same savings or maybe the same credit to get loans. Things of that nature are going to dictate, barrier of entry is going to be important when considering what to invest with those situations. So, like I said, let's just get right into it, and we're going to go and jump into that first thing, and that first thing is going to be stocks. Yes, stocks. Everybody knows what these are. They're the most commonly heard of investment, and that's why I'm just kicking them out right now. So again, I'm going to be going over those 4 things, so just keep up with me and we're going to go through it. I'm going to explain things along the way just so you know what I'm talking about. All right, so number 1, stocks. Stocks, the payments that are received from stocks are through appreciation and dividends. So now I want to talk about what these are. So appreciation is something that happens when you buy a share at a certain price, and after you buy that share at that price, demand for your share or for the share in general may go up. Now, when this happens based off of the law of supply and demand, there's only a certain amount of shares out there in the market. So if there's a finite amount of shares and demand for your share has gone up, meaning there's more buyers than there are sellers, that's going to increase the price of your share, which is called appreciation. So now if you were to sell that stock, you would then receive the appreciation, the difference between what you paid and what it's being bought for is the appreciation, and that is the profit that you get to retain. Now, something to note importantly about share prices is when the price does go up, you're not being taxed on the amount that it goes up until you actually sell the share. So that's important to keep in mind. Now, appreciation differs from dividends in that it's not dictated off of the law of supply and demand per se. What happens is it's based off the company's dictated policy for how much they're going to pay out to you in the form of a dividend. So, in other words, what this is it's a portion of the company's profits that are being distributed to the shareholders, aka you, and everybody else who owns that share. Now, usually this dividend is distributed quarterly. Some dividends are distributed monthly, but it just depends on the stock that you buy. Now, let's move on to the level of risk with this one. The level of risk, it depends. It depends in the sense that, number 1, are you speculating or investing? And what I mean by that is speculating is when you are assuming that the price of your company's stock is going to go up based off of trends, fads, or just, maybe your opinion. So pretty much everything besides fundamental investing. Fundamental investing is really when you actually look at the underlying company and see, is this company actually making a profit? Is it profitable? Is it keeping its debt low? Things of that nature is more of a fundamental outlook. So that's why I say it depends. Also, are you combining these stocks with a diversified portfolio of maybe long-term bonds, short-term bonds, golds, and commodities? Or maybe if that's not your style, are you combining it with cyclicals and non-cyclicals? Things of that nature. So the level of risk is going to depend. Now, the barrier to entry is low. That's the bright side. The bright side is pretty much anybody can go and open a brokerage account at Charles Schwab, Fidelity, E-Trade, any of these brokerages, and they can, as long as you have the money to transfer over there, you can start investing right away. So that's good, and almost anybody can find a share that is at a price that they can afford. So that's a good thing. Now, the potential for gain in stocks is very high. I mean, let's be serious. I mean, look at Warren Buffett. We know that the potential for gain in stocks is high. But you got to be careful with that one because sometimes the potential for gain is very alluring. And that alluring temptation can sometimes bring you into that investing style that leans more towards speculating. So you want to avoid speculating, and you want to be an investor. All right, so let's move on to number two. Number two is going to be government bonds. Okay, so the payments received from this is interest. Now, what interest is, just to define it real quick, is interest is an agreed upon percentage that is allocated to you over a certain period of time for you giving up a portion of your money. So, in other words, again, you give away your money essentially to a government bond, which is the United States government. And in return for you letting them use this money to, build bridges, build schools, or possibly refinance the debt that they have and pay other bondholders, you are guaranteed back an interest rate, which depending on what bond you get, whether it's a T-bill, treasury, the years vary on how long you're going to be accepting that. Now, the level of risk is pretty low. Now, the reason why I'd say it's low is because even though, opposed to popular belief, and I know there's all this stuff going on with, the U.S. national debt and stuff like that, but opposed to popular belief, the government has never defaulted on its debts. Now, the reason why this is true is because the U.S. government debt is really misunderstood. The U.S. government debt is actually, the majority of that money is owed to ourselves. And what I mean is that when the government issues these bonds out, they have to pay interest on those bonds. So let's say, for example, your parents bought those bonds and now they need to be paid. Now, obviously, in order for the government to pay for your parents' bonds interest, they have to get the money somehow. Now, one of the things is that taxes are not a popular way to do that because, if politicians start raising taxes, it lowers the likelihood that they're going to get voted into office again. So oftentimes what they do is they usually have the Federal Reserve refinance the debt. And pretty much how they do that is they issue more bonds. Now, let's say they issue the bonds to me. Now, by me buying that bond and being guaranteed that interest, that money that I just handed over to them allows them to go ahead and pay, my parents, your parents, and other people that they owe debt to. So again, opposed to popular belief, we're not going to go into bankruptcy. The country's not going to be coming and collected on, and the majority of that debt is owed to ourselves. All right, so moving on to barrier to entry. Barrier to entry is low. Again, this is another bright side. Anybody who has some spare leftover cash that wants to get into a little bit investing, they can, with a relatively small amount of cash, can go and actually buy these government bonds. Now, the potential gain is also going to be low. All right, the potential gain is low because since you are buying such a secured form of investment, meaning that it is very low risk, you are going to receive a lower return for it. Oftentimes, these returns for sometimes 10-year treasury bonds can be somewhere around 1.75 to 2.125%. Now, the problem with that is that usually inflation is higher than that. And that kind of deters me from buying too many government bonds because ultimately inflation is going to eat away at the money that you're left over with. And don't forget that you have to pay taxes once those government bonds mature. All right, the third investment that we're going to talk about is corporate bonds. All right, so corporate bonds are a little bit different than government bonds. Corporate bonds are not issued by the government. They are issued by, you guessed it, corporations. Now, these corporations or businesses, they also pay you in the form of interest. So payments received are interest. The level of risk is going to be moderate. Now, the reason why these are moderate is because corporate bonds are backed by the rating. Now, there's rating agencies out there that rate businesses for their corporate bonds, but you're pretty much backed by the rating of the company. And what I mean by this is that based on the health of the company is the amount of risk that you are taking by buying these corporate bonds. So, in other words, if a company was to go out of business after you bought a corporate bond, the company would then go and file bankruptcy and then would have to sell off its assets. If after paying all its debtors, it had enough money to pay the corporate bondholders, at that point, that's when you would receive your money. All right, so they have to sell off all their assets and then you would receive your money. Now, the good thing is by being a corporate bondholder, you're pretty high on the level of priority. Usually what it goes corporate bonds, then preferred stock, and then common stock. Common stock holders, which is a stock most people, what we were talking about earlier in the above, number one stocks. Common stock is usually that one that is the last on the priority list. So if a company does go into bankruptcy, common stock is going to be the last one to receive the money from the sale of those assets. All right, so like I said, corporate bonds, they definitely have a moderate risk to them. You want to definitely go into investment grade bonds or high rated corporate bonds. Now the barrier to entry again is low. So again, that's good because a lot of us who may not have tons of cash sitting on the side, but we still want to invest, these corporate bonds are going to allow us to do that. Now, the potential for gain is moderate. Now, the reason why it's moderate is because if you are, let's say you want to dabble in a little bit of high-risk corporate bonds. When you get into those high-risk corporate bonds, their ratings are going to be lower. But at the same time, their interest rates that they're offering on the corporate bonds are going to be higher. Now, the reason why this has an inverse relationship is because since you're taking more of a risk with their company, they know that. So they also know that they're going to have to entice you by offering you a higher interest rate. So that's why they do give that higher interest rate. Now, if you throw into a couple high-risk corporate bonds into a mixed portfolio of other corporate bonds that maybe are backed by safer securities, then that's why I say it could be moderate if you diversify it. It also could be potentially high. It just depends on really how much risk you want to take. All right, so let's move on to number 4. Number 4 is real estate. Now, this is a hot topic today, man. I feel like everybody and their mother's getting into real estate. People are just loving this stuff. There's so many channels out there. There's so much talk about it. There's so much buzz. The prices of homes are going up. Millennials are stressed because they're trying to figure out how they're going to afford homes with this the appreciation of prices in this current environment. But anyway, let's move into it. That's just jibber jabber. The payments that you receive from this are rents and capital gain. Right? Let me give you an example of rent. Let's say that you go and buy a home, and after you buy that home, you decide to rent it out to a tenant. Now, when you rent this house or condominium or multifamily home out to a tenant, it's implied in the name. You get rent. All right, so that rent up and above the cost of your mortgage, if your complex has one or if your house has one, that will be your profit. Now, don't forget to take into consideration that you will have to include in your profits, in your calculations on return on investment, the things that you have to fix throughout the year. So, for example, if you have to go and fix that toilet, that obviously fixing that toilet and calling that handyman is going to cost you something, which obviously is going to come out of your bottom line. So, to make sure not to make the mistake of just counting everything as profit, because it's not. Another example, so we're going to move into capital gains. Now, an example of that is, let's say you go buy a home for a short period of time, and your goal is to fix and flip this house. So after you fix and flip the house, that profit that you receive from the difference of what you bought it for and the price you put in to rehab it, and then the price that you sell it for, the difference is a profit. But since you're going ahead and you're getting this profit in the form of a lump sum, it's going to be a capital gain. All right, so that capital gain. Now, you got to be also careful with this too. The reason why I say this is because a lot of times some smart investors, it really just depends on your preference, but some smart investors looking to kind of draw down on their tax burden, what they'll do is oftentimes they'll go ahead and flip a house, but then they'll immediately rent it out. So they'll start collecting rents from a tenant And most of the times what they'll do is they'll hold it for at least over a year. And the reason why they do this is because if you hold any type of investment for over a year, you get charged something called capital gains tax instead of income tax. Now, income tax is tax like pretty much the tax that you get on your income, which is higher. And it's also going to be paid based off of your tax bracket. But when you hold that house, for example, or an investment for over a year, you get that discount rate of a capital gains tax, which is generally around 20%. So the potential for gain here, let's go back. The barrier to entry here is going to be high. And the reason why I say this is because when you're purchasing a home, they don't have homes out there like stock, like they do stock that sells for $20 a share. These homes are going to be a lot more expensive. They're going to require a 20% down payment, which is going to obviously cost you upwards of $20,000 and up. Now, there are different creative ways that you can get into it without having to spend as much money. For example, you could use a hard money lender. Hard money lenders, they're not so much interested in the credits that you have or the amount of money that you have. They're more interested in the deal itself, but they're still going to look to see that you have some type of skin in the game. So now how a hard money lender works is most of the times what they'll do is they'll finance up to 90% of the loan to value, the LTV, and then they'll also finance 100% of the rehab. But they're going to expect you to put at least down 10% because, like I said, they're looking for skin in the game. All right, so moving on to that next one is the potential for gain in real estate. The potential for gain in real estate is really high, and that is probably really what is influencing this popularity, the fad, the buzz right now that is going on in our society. A lot of people are trying to get into real estate right now because it is becoming common knowledge that the potential for gain is extremely high. And not only is it extremely high, but it provides a passive income, a lifetime source of income sometimes, and it allows you to. It's literally like a game monopoly. It allows you keep upgrading. You keep upgrading. You go from a house to 3 houses to an apartment complex to a whole commercial building, maybe a mall, and that's really the potential for this gain and where it could go. All right, so the fifth thing that I want to mention today is going to be tax liens. So tax liens is something that a lot of people are commonly hearing about, but it's something that I particularly like. And the payments that are received in tax liens is interest and, again, capital gains. So first, let me inch back a little bit. So a tax lien is often associated with negative feelings. And the reason why I say this is because it usually the investment is created out of hardship. Now, to explain what a tax lien is, imagine that grandma or grandpa has a house. And I know this is going to hit, that soft spot. Let's imagine grandma and grandpa has a house, right? And grandma and grandpa, they didn't save up necessarily enough for retirement. And now they're faced with still having to pay property taxes. Their home's paid off, but they still have to pay property taxes, but they can't afford it. So they stop paying the property tax because they have to pay for other things that are important to them, like food and, the clothes on their back and things like that. So what happens is after they stop paying their property taxes, the state doesn't have too much time anyway, to wait on them to pay their taxes because those taxes are being used to build schools, to pay teachers, to build new schools, to provide public services, unemployment services, things of that nature that the state needs this money for. So oftentimes what the state will do is they take this tax lien and they sell it to individual investors. Now, the way the sale works is it is an auction, but the state does try to put it in favor of the person that has this, this issue with their paying their taxes. So whatever interest it is that, they're charging, they have a legal limit. Let's say that's your state's legal limit is 30%. You can go as high as 30% interest on these tax liens. Now, what happens is the investors are going to bid the interest rate down. So whoever is willing to accept the lowest amount of interest on this tax lien is going to be the one who receives the tax lien. Now, what happens is when you receive this tax lien, the investor pretty much becomes the bank. They have a claim to this mortgage. And the reason why I say that, well, they become the state. Let me correct myself. They become the state. So what happens is that if this person doesn't pay you what they owe in taxes, plus the interest owed, you can foreclose on them. You can foreclose on the house, and you can take the house for dirt cheap. Now, there are going to be some risks associated with this, and I'm going to get to those next. Now, let's move on to those payments received. The payments received are interest and capital gains. Now, you're probably thinking to yourself, wait, you just explained interest, so I get that. Interest I get. But where are the capital gains coming from? The capital gains come from the fact that if you foreclose on the house, and you take ownership of this thing, now technically you can go and sell it. You can keep it, you can rent it, you can do whatever you want. So there's potential for a lot of different incomes. Now the level of risk, let's move on to level of risk. The level of risk is going to be moderate. And the reason why I say moderate is because on one end of the spectrum, you have this huge benefit of possibly receiving a gigantic gain by foreclosing on this house and receiving interest as well, even if you don't. But on the other end of the spectrum, there is a hidden risk. And that hidden risk is that sometimes if you don't do your homework or your due diligence on this tax lien that you're buying, you could inherit a tax lien that has other liens against it. Maybe a maintenance lien, maybe an electrical lien. Maybe this person hasn't been able to pay their bills to several different vendors and they have liens against the mortgage. So when you buy that tax lien, you inherit those liens. Now, don't get me wrong, since you have the tax lien, you do have the senior lien. But this is a potential that could happen. The other thing that can happen is that what if you potentially buy a tax lien for a commercial property? And what if that commercial property, say a factory or whatever the such may be, is polluting the land? What if they're dumping waste into a river or something like that? If you purchase that tax lien and you end up owning that thing, you are responsible for fixing that. So again, you need to do your due diligence on this because there's an upside and there's a downside to everything. Now, the barrier to entry to this can be low. It can be low because there are some tax liens out there for as low as $500, $200, $1,300. And all you have to do is go out there and you pay that tax lien for the owner of the home, and then at that point you become owner of that tax lien. Now, the potential for gain, we're going to go ahead and say that is high. The reason why it's high, again, is because if you do find that 1 in a million where you get to repossess that house and foreclose on it, you just could have bought a house for $1,300. Now, given there are some other things that are involved in that, but the potential for gain is high. Now, again, back to the beginning, this is associated with a lot of negative feelings because, grandma and grandpa, that is maybe someone's grandma and grandpa. And you may be looked at as the bad guy, but ultimately, you got to look at it this way, and you could feel guilty about it if you want to, but you got to look at it from a different perspective. And that perspective is that either way, this couple is going to be given an extended amount of time. The state is putting it in their favor by drawing down the percentage to the investors, and ultimately they're being given time to fix their situation. But if ultimately they can't fix their situation, this was inevitably going to happen anyway. And I know a lot of people are going to be like, oh, well, they should be charging them the taxes, or they should give them the break. They're old. Why can't they just own their home? And, I understand that too, and I'm sure all of us have that gripe. But ultimately what it comes down to is that our local and state governments are going to have to pay for, these teachers' salaries, these school salaries, to build new schools and roads. They have to pay for these somehow. So those again are the 5 different types of investments that you can take a look at. Again, if you want to rewatch the video, let me know. Like I told you in the beginning, this is actually a part 2 to investing for beginners. If you do want to check out that part 1 and investing for beginners, you can check out that video. I made it a few weeks ago. That tag for the video is going to be, I believe, up somewhere in this corner. Lastly, don't forget to subscribe. Make sure you hit that thumbs up button. And if you have any questions, please let me know down in the comments below. I will be there to answer any questions you have. And again, remember, don't rest until you invest.